What's up, everybody? We have two companies to talk about today. They are both extremely high quality, market leaders, and they're trading for reasonable prices today. So let's jump right into it. The first company is one we've talked about before. It was in my 2 stocks to buy for June video about a month and a half ago, and it's up 25% since then, but they just reported earnings on Thursday. The market liked it, and I think prospects still look good from here. The company is Evolution, and they make live casino games. Essentially, they have studios all over the world where they are streaming blackjack and other casino games, along with a bunch of their proprietary games like Lightning Storm, and they license these games to casinos, to operators. This is an extremely high margin business, and this live casino space has been growing immensely the past few years. It really got a boost during COVID. You can see from their top line here. Recently, revenue growth is slowing down, but the operating margin is still incredible. I mean, these are numbers you don't see from many companies. More than 50% free cash flow margin. Just to put it in context, Evolution's net income margin is pretty similar to Visa and Nvidia, Broadcom, MasterCard. So a very high quality business, and it's also the market leader. You can see Evolution's player numbers going up over time, and their closest competitors, Playtech and Pragmatic, they are significantly far behind and honestly only becoming further behind. As you may know, I love investing in market leaders if I can. They typically have better margins over their peers. They typically have an advantage in scale, and often the thing that turns me off is their valuation. Sometimes quality companies can just be too expensive and I don't want to pay it. But Evolution is currently trading for just 10 times their operating income. This is a company with essentially no debt, a perfect balance sheet, incredible margins, the leader in their market, buying back stock on top of that, and they're trading for just 10 times operating income. So why is Evolution so cheap? I mean, you see in our little price chart right here, Evolution is less than half of what it was trading for back in 2021. And that's what happens sometimes when a growth story suddenly has slowing growth. You're not seeing the 40-50% growth anymore, you likely won't again, and the multiple has just collapsed. Also, this live casino space is becoming much more regulated now. We're seeing that especially in Europe. In the middle of Q1, they said, hey, we're taking measures to make sure we're complying with European regulation, but that really was a hit to their revenue, and this only affected half of Q1. They said during the last call that Q2 in Europe is going to be even worse because they're going to be hit with the full effect of these regulations. Also, in Asia over the past year, they've had a large problem with cybercrime. Essentially, people would hack their streams, hack their video feeds, and they could profit off of Evolution's IP without, giving any cut to the company. This quarter, they said they've made headway dealing with cybercrime, and we see growth re-accelerating in Asia, which is great to see. And the end result is that for this quarter, revenue grew year on year at 3.1%, which may not sound like much, but they report in euros. The euro is up a ton this year. And if we look at the company on a constant currency basis, which is a much better way to estimate organic growth, then they are up 8.8%, so about 9%. The company does not give full year guidance, but they reiterated their margins for the year are going to remain strong. And they just opened up 2 new studios in Brazil and the Philippines. These were not open during their second quarter, but they're hopefully going to be contributing to Q3 and going forward here. Also, what I love about Evolution, they do not need to reinvest much capital to continue growing this business. Just 140 million euros for CapEx this year. That's just roughly 10% of their operating cash flow. And that leaves a lot of money left over for buybacks and dividends. And they do return a lot of capital to shareholders. If you go to their press releases, you can see every week they publish how many shares they bought back. So the week of July 7th to the 11th, they bought back almost 200,000 shares. Insider ownership for this company is very high. The CEO, in fact, was buying shares on the open market just last month. And that's a huge green flag, having management aligned with us shareholders. Looking at some assumptions about the future to see what we can expect for a return on our investment investing in this stock. In my base case, I'm forecasting 7% revenue growth every year for the next 5 years. I'm forecasting margins to pull back a bit from where they are right now. And I'm only giving this company a 14 times multiple on operating earnings, which I think is not demanding at all for a quality company like this. And if these assumptions come true, you're looking at an 18% annualized return, which is an excellent result. Even if I give them no credit for any multiple expansion, their multiple remains this low, you'd still be looking at a 12% annualized return, which likely would beat the market. My bear case has revenue just growing 4% and margins pulling back even more. Their margins for the past 5 years have vastly exceeded the numbers I'm putting in here, and I'm only giving them an 8 times multiple. And even if these assumptions come true, you're looking at making 4% every year on your money in this stock, which might not sound good, but you have to understand, typically in my bear case, I'm looking at at a negative return. I think there's just huge asymmetry in this stock between the downside and the upside that we might experience. I mean, if growth reaccelerates from here to 10%, remember on a constant currency basis, they're at about 9% right now. And if sentiment shifts around this stock to just give them a 20 times multiple, which for such a high quality company, this is not crazy at all. And you would be looking at a 30% annualized return for 5 years. This would be close to a 4x on your money if this scenario comes true. So yes, in my opinion, I think Evolution still looks great, even though it's 20-25% higher than we last talked about it. I think the risk reward is still excellent. Full disclosure, I own the stock. I may be biased. This is just my opinion. I'm not telling any of you to buy or sell this stock. Now, before we go on to the second company, if you're getting value out of this video, subscribe to the channel. It really helps me out. Leave your thoughts on Evolution down below. And now, let's move on to the second company. This is a pretty big company. A lot of you are probably familiar with it. It's ASML. If you don't know, ASML is the company that makes these EUV lithography machines. They are the only company in the world that makes these machines. And these machines are basically like the peak of human engineering today. Essentially, you have light sources which are powered by these lasers that are bouncing off of these mirrors at pretty much atomic level precision, and they're then hitting droplets of tin at like 40,000 or 50,000 times a second, all to develop a wafer into a semiconductor chip. Oh, and by the way, this all has to be done in a vacuum, so you don't have light absorption or dispersion from literally the air particles. So the technology is mind-boggling. I mean, these machines are not small either. You can see the size of one of their newer machines here relative to some people. This one, it says, is 165 tons. So absolutely massive, but without these machines, you don't have NVIDIA's super high performance semiconductor chips. It's only with one of these machines that you can get that super fine detail on these little wafers. Again, no one else makes these, and there really isn't another technology that seems to be on the horizon to compete with this. So ASML has arguably one of the strongest monopolies in the world. They're able to charge a just massive price tag for one of these machines, and we've seen their margins creep up over time too. So increasing revenue with increasing margin, this is clearly a very dominant business. Now, they just reported results for their second quarter, and overall, I think it was a pretty decent earnings report. They're saying demand remains strong. They reiterated some long-term guidance, saying they see 2030 annual revenue between approximately, there's about 50 billion US dollars to 70 billion US dollars, with an even further improvement to their margins. Breaking down their sales, about half of it is EUV machines, but you see, I mean, this can vary a lot by quarter, just based on how many machines they sell. You see, last quarter they sold 14 EUV machines versus 11 this quarter, and EUV was 56% of sales last quarter. They don't put their customers on this side, but their three largest customers, TSMC, Samsung, and Intel, they make up a massive amount of their revenue. Anywhere from like 60 to 75% depending on the quarter. So, if TSMC or Intel really pulls back on the CapEx, that is a risk here. Now, looking through the results, I was actually surprised to see that ASML dropped about 8% on this report. And some people have attributed that to, this remark that management said, going into 2026, the fundamentals of our AI customers remain strong and we are still preparing for growth. However, as we discussed last time, the level of uncertainty is increasing. Management seemed to hint that there might not be growth in 2026, and maybe that's what spooked the market. But if you look at the revenue history for this company, there have been multiple years where the revenue has just been flat. I mean, this is kind of lumpy growth. If we look at this chart here, it grows and it's flat, it grows and it's flat. I mean, if Samsung or TSMC have a year of lower CapEx, obviously you would see that reflected in ASML's numbers. But I just think in the long run, ASML is a monopoly. There's no one else selling these machines. Their growth may be a little bit uneven, but in the long run, it's going to go up. So as far as some assumptions about the future, my base case is just assuming they hit the midpoint of that 5-year target that management put out. This is a company that has often come in ahead of guidance, so I think this is reasonable. And as far as a multiple to give this company 5 years from now, this is where some people might have different opinions. I gave them a 25 times multiple on operating earnings, which is pretty expensive, but I just don't even see any company even close on the horizon to competing with them right now. I think this is one of the strongest monopolies on the planet, and I think they deserve a good valuation. And with these assumptions, you're looking at a 15% annualized return, which would be a double over 5 years. In my bear case, I'm assuming just 5% revenue growth, and this would be in a scenario where the CapEx of these major fabrication companies starts to slow down a little bit. I'm assuming operating margins stay consistent with where they are now. And in this scenario, I gave them an 18 times multiple. And if these assumptions come true, you're still up a little bit on your money over 5 years. And as far as what we could be looking at on the upside, if I give them 16% revenue growth, which is where their long-term average has roughly been, and if I give them credit for further margin expansion and a 30 times multiple, which for a company like this, I don't think is unreasonable, then you're looking at 28% annualized over 5 years, which would be like a 3.5x on your money. In that scenario, ASML would be trading at about like $2,500 a share in the year 2030. So all in all, I think ASML is offering pretty good risk reward today. Again, I don't own this stock. It is a stock I have been looking at for a little bit. I think for me, I would still like to wait a little bit more. I'd like to buy this somewhere in the 600s. If I could buy this right around 600, I think that would be a good purchase. I actually had the opportunity to do that back at the sell-off in April. However, when stock sold off in April, there were tons of good opportunities and I was buying other things. In any case, let me know what you think. Do you own ASML? Do you agree? Do you disagree with anything I said here? If you like this video enough to be watching this far, go subscribe to the channel. It helps me out a lot, and I hope to see you in another video.